today we're going to go over navigating taxes as a locum tenens provider or a 1099 contractor. And Andrew is going to guide us through this. So go ahead, Andrew, take it away.
Okay, thanks, Stacy. My name is Andrew Schwartz, partners with my brother Rick Schwartz, a CPA firm. Schwartz & Schwartz. We're based north of Boston in a city called Woburn, Massachusetts. It's actually kind of close where Barton's office is. It's probably 10 or 15 minutes down the highway when there's no traffic. We have a very narrowly focused niche CPA firm here, specializing in healthcare professionals and their practices. It's pretty much all we do. It's exclusively healthcare. We're starting our tax season. This is actually my 38th tax season that I'm starting. My brother's a few years less, even though he's older. And we're going to do about 2,500 tax returns for physicians, dentists, and mental health practitioners or behavioral health practitioners. So we're very familiar with the issues affecting healthcare professionals and their basic financial planning lives and things of that nature. So let's go through and see some of the tax saving opportunities and basic financial planning issues affecting locum tenens providers. Okay, so one sec. Okay, so here's a little bit of our agenda. We're going to talk about common deductions that you're allowed to deduct if you're locums, the retirement account options, health savings accounts, which are really great, paying the taxes due because they don't withhold taxes as you're paid as a 1099 contractor, so paying quarterly estimated taxes. The QBI rule, which is still in effect, it's supposed to sunset in 2025. That came into existence in 2018, big tax law change. We'll talk about some planning tips, and then we're going to address state tax concepts and S-corporation consideration. So it's pretty thorough. We're going to just touch on a bunch of different things relatively quickly. As we were talking about a few minutes ago, Stacy and I, there is a handbook that you're going to be able to download from the Barton site that goes along with the slide deck. And that just is a little bit more in detail. So let's get right at it. Okay, so when you work as a locums for a company like Barton, when they pay you, they don't pay you as a W-2 employee, so they don't withhold taxes from your pay. Instead, you are compensated as a 1099 contractor. Okay, so you go to wherever they assign you to work. When it comes time to get paid, you get paid 100% of the money that you're owed, no taxes withheld. And when you're paid that way, it provides a lot of opportunities to save taxes and do some other tax-wise investing and things of that nature. So the first thing is when you're paid as a 1099 contractor, you have the opportunity to deduct expenses, professional expenses directly against that income. Now, the threshold that the IRS sets for people who are independent contractors or sole proprietors or have their own small business is an item is deductible against the income if it is both ordinary and necessary in connection with your profession. So if you go and you get a laptop computer that you can keep track of your schedule and use it when you're working, I would say the laptop computer would definitely qualify as ordinary and necessary. If you get one of those bags, one of those $8,000 bags from Paris I saw, or wherever it's from that I saw on 60 Minutes the other week, I don't know, Walmart just made the knockoff on it. If you get one of those bags, you might think that's ordinary and necessary, but I think that the IRS would disagree. Okay, so the threshold is ordinary and necessary. There's a whole list of expenses. It's basically licensing, dues, malpractice insurance, and anything else, any other expenses you incur during the year in connection with being a locums provider that I wouldn't incur because I am not doing that type of work. Okay, so we're going to talk about health insurance, travel, lodging, meals, automobile expenses, and education, licenses, and examinations. So let's get right at it. Okay, so health insurance is a big one. So if you are paid only as a W-2 employee and you're required to get your own health insurance, the only way that you can deduct the health insurance is as a miscellaneous, as an itemized deduction, and your medical cost, your health insurance and medical costs are only deductible to the extent that those costs exceed 7.5% of your income. If you're doing locums and getting paid as a 1099 contractor, 100% of the health insurance premiums you pay are deductible on your tax return. So that's one big advantage to people who are compensated as 1099 contractors. There are a few things to be aware of. First, if you buy your own health insurance, that counts. If you're 65 or older and you're paying Medicare for yourself or your spouse, those Medicare premiums count as health insurance, which is deductible on your tax return. But on the other hand, if you are married and you have access to health insurance to a spouse, then in theory, the premiums you pay, if you get your own health insurance when you have access to health insurance through your spouse, that's not supposed to be deductible. And if you work as a locums, but you also work as a W-2 employee somewhere and you get access to health insurance for that company, but you'd rather buy your own health insurance, same thing, that health insurance isn't supposed to be tax deductible. But Medicare is the big one. People don't always think about that, but if you're doing locums later on in your career, make sure to remember to deduct your Medicare premiums. The second thing is a really big issue, because when you do locums, you travel all over the place, and you want to figure out which of your travel, lodging, and meals are tax deductible. So this whole thing is based on the concept of a tax home. So where you live and work, that's your tax home. Once you establish a tax home, if you go somewhere else for a year or less to work with the intent of returning back to where you were living originally, that time you're away is treated as one long business trip. It's as simple as that. And when you're on a business trip, you get to deduct travel back and forth between your tax home and where you're having your business trip, the cost of lodging, so whether it's in a hotel or you're renting an apartment, and then also 50% of the cost of meals while you're away. So for the travel and the lodging, the deduction is based on actual expenses incurred. So it would be what you really paid for your flights and for your hotel or for your Airbnb that you're renting. That deduction is based on actual costs incurred. But for your meals and incidentals, there's two ways that you can claim the deduction. One is you base the deduction on actual expenses incurred. You keep the receipts, or you pay for everything out of one credit card or something like that. And you base the deductions on actual expenses incurred. The other way is you base it on the per diem rate. And the per diem rate is it's a set amount per metropolitan area per day. So let's see if this is going to work. Let's see, cross your fingers. Okay, here we go. So if you click on this link, it takes you to the U.S. General Service Administration, and right down here they have per diem lookups. So let's say you wanted to go to Boston, Massachusetts. We can just do this, and if we search, where's search? I don't know. Where's search for this thing? Choose. I can never do this. Choose a date. We can collect a year. We'll do last year. Okay, here we go. Search, and it has it. So let's say you went to Boston. We can't use that. We have to use the meals and incidental, and it's $79 a day. So without keeping any receipts, you get to claim a deduction of $79 per day that you're on your business trip, that you're doing your locums outside the general vicinity of where you live. And meals are 50% deductible, whether you base it on per diem rates or on actual expenses incurred. And if you're traveling in Alaska, Hawaii, or any foreign location, you would click on this link and they would have the meals and incidental for that city. So it's nice and easy. There's one more rule, and that is you need to be consistent by business trip. So whenever you're on a business trip, you either base your deduction on actual expenses incurred or on the per diem rates. But if you go on multiple business trips during the year, you can switch back and forth to whichever one gives you the better deduction. But here, the government actually made our life easier. And most of my clients, they base their deduction on the per diem rates. It seems like that it's easier and they get a better deduction. The next thing is automobile expenses. So if you're close enough to where you can drive to your per diem spot, then this might make sense. So deductible miles include driving between job sites, driving between your home and a temporary job site, and traveling to job interviews and conferences. So if you are doing one of these locum tenens positions, and it's going to last for a year or less, and you intend to return back to where you were living before, that is considered a temporary job site. A temporary job site is somewhere you're working for a year or less. Okay, so that means all the miles driving there, if you're driving back and forth instead of flying, are deductible. Now, there's two ways that you can claim your business miles. You can either base it on the standard mileage rate, which was 67 cents per mile last year, increasing to 70 cents per mile this year. The IRS makes a big point to this year when they notified when they put out the news release about standard mile rates. They said the same rate applies to EVs as regular cars, because EVs don't need gas, so in theory it should be less. But it's the same 70 cents per mile. So all you do is you figure out how many miles you drove from your home to the temporary job assignment, and all the driving that you did while you were on your temporary job assignment. That all counts. You're on one big business trip. And you just multiply it by either 67 cents for last year or 70 cents for this year. Any parking and tolls you can add to the cost of the standard mileage rate. So that's over and above. The second way to make the calculation for your auto expenses is to base the deduction on actual expenses incurred. And you just calculate the ratio of total miles driven divided by, business miles driven divided by total miles driven. And actual expenses incurred: gas, insurance, repairs. Parking at home counts. So if you have to pay for parking around where you live, that's an auto expense. Lease payments if you lease your car are a factor for depreciation. If you own your car, what I've seen over the years that the 70 cents or 67 cents per mile is pretty good. If you drive a lot of miles every year, maybe besides the first year when you buy the car and can claim depreciation, you're usually better off doing it on the standard mileage rates. If you drive very few miles during the year and most of those miles are business miles, that's when you're better off claiming the deduction based on actual expenses incurred. And if you do claim depreciation the first year you own a car, then you're no longer allowed to do standard mileage for that vehicle, according to the IRS regulations. Another interesting deduction is education, licenses, and examinations. So basically, the rule is as follows. Anytime you do something that qualifies you for a new trade or business, those expenses are not tax deductible. That would be medical school, if you're in medical school, dental school, undergraduate, college, anything like that. Initial licensing in your first state doesn't qualify as well. But anytime you do something that improves your skills in your current trade or business, that would be deductible. And that includes getting licensed if you have to pay for it in other states. That includes if you're in mental health, if you're undergoing analysis as part of improving your skills as an analyst, those would count, as well as your supervision. If you take a course, a college level or graduate level course for a year or less with the intent of improving your skills in your current trade or business, like something about like maybe with business management or things like that, that would all count. A practicing dentist that's involved in a specialty program, they can deduct the cost of their specialty program tuition. So reaching the level where you can work in a profession, not deductible, but everything else is all deductible. And you want to keep track of all those expenses because it's a big deal to write off expenses directly against your income. It's actually the first and best way to save taxes. So let me just go over this real brief. We don't have a slide on this. Let's say you work as a locums and you make $100,000. So if you don't have any expenses, you'll pay taxes on the whole $100,000. But let's say between your travel and lodging that's not reimbursed and some of these other expenses that you would have during the year, let's say you are able to come up with about $30,000 worth of expenses. Well, in that case, you're not going to be taxed on the $100,000 of income. The $30,000 of expenses that you deduct completely offset the $100,000 of income, directly offset the $100,000 of income. So you'd only be taxed on $70,000 of income from your 1099. So it's a huge deal. For that reason, we're going to talk about this in a little bit, but you do want to set up a really good system to keep track of all your expenses because the marginal tax rate on people who are earning 1099 income is quite high. You want to do what you can to not spend money to save taxes, but track the spending. So if you do spend the money, you make sure to have a list of expenses available for your tax person, so they make sure to write off all those costs. Okay, it's interesting, huh? Very interesting. Let's see. I know I said I wasn't going to do this. Okay, so one question is there a minimum number of days you need to do locum in order to claim the deductibles? Uh, no, I don't think so. If you earn 1099 income, you're able to claim expenses against that income. And if you do locums for 2 days during the year and you had to fly somewhere and get a hotel so you could work there and you weren't reimbursed for those costs, I would say that you can, here's the questions, by the way. Well, I don't want to have people think, okay, I would say you can, you would deduct it. So if you earned $2,000 for your 2 days, or whatever it works out to be, and you have $1,800 of expenses, the $1,800 would offset the 2,000. You'd be taxed on $200. How about NP going to school to get DNP? I was wondering that. That's why I didn't say it. The question is, does being an NP improve your skills as a nurse or qualify you for a new trade or business? I think that when you become an NP, there's things that you can do that you can't do as an RN. So I'm not sure that becoming an NP would qualify as deductible education expenses. I'd have to look it up, but that's my gut feeling, because NPs can prescribe and do some things that RNs can't do. So I think it qualifies you more or less for a new trade of business. An NP would be considered a new trade of business, I would think. What about paying Medicare? Yeah, I mentioned that for the health insurance. Medicare definitely is a medical, it qualifies as health insurance, and you would deduct that on your tax return. As health insurance, last question, I am a 1099 employee working 2 days a week from 8 a.m. to 6 p.m. Can I count just a lunch? Okay, here's the rule. Oh, so the question is, what qualifies as a business meal? So if you are outside the general vicinity of where you live, if you are far enough away from your home that you can't drive, you can't commute to that location without resting before you return home, then all your meals are deductible. You're on a big business trip. If you're in the general vicinity of where you live, actually none of your meals are supposed to be deductible. There is something where if you're required to stay on site, I guess you could argue that would be that lunch would be deductible, but your breakfast and dinner wouldn't be, because you're not on a business trip. What I'm talking about counts if you are outside the general vicinity of where you live. Okay, great. Okay, next up, let's talk about retirement accounts. So during your working years, the first and best way to save taxes and take advantage of a lot of basic financial planning needs is to maximize what you put away into these pre-tax retirement accounts. Okay. So when you work for a company, you have access to a 401k. If it's a college or a hospital, maybe it's a 403b plan, but both of those are pretty much the same thing. So you work for the company, you put away money through salary deferrals. So you tell your HR department how much of your salary you want to put into the retirement account. The amount you put into the retirement account usually reduces your taxable earnings and grows tax-free. All right. When you're self-employed and get your own 1099 income, it's up to you to set up your own retirement plan. But let's first talk about the value, the importance of why retirement plans are so great. Okay, so if you go and you invest your money in the stock market, let's say since for the past 25 or 30 years, the market basically has gone up a lot in the last 25 or 30 years and longer. But the average rate of return is about 10% per year. If you put in the S&P 500, I think it's actually a little bit higher. It's probably the rate of return for the last 20 years is probably 12% annualized, which is great. That's a good rate of return. And if you put the money into a nice fund like that, and you consistently put the money away and keep it there, you're going to build up a nice nest egg. But I'm going to show you how, by taking advantage of retirement accounts, whoop, 1 second. Sorry about this. I haven't signed out. You get a much higher rate of return than 10% that you get by investing over time. Okay. If I were to tell you I can give you a 49.25% return on your money, you would say, Andrew, you're crazy. But I'm not crazy. Here we go. So let's say you work and you're in the 28% federal tax bracket and the 5% state tax bracket. So combined, you're in the 33% tax bracket. Any dollar you earn, every next dollar you earn, 33% goes to the government, and then you get to keep 67% of what you make. Well, if you put money into a retirement account, the whole thing changes. So instead of earning $1,000 and ending up with $670, you can take a percentage of what you earn, and let's say you put the whole $1,000 into a retirement account, instead of the government getting $330, you invest all $1,000. So instead of having $670 left over after paying the 33% to the government on $1,000, instead of having $670, you can put the money in a retirement account. It really only costs you $670 today because you're not going to pay the taxes, and you have $1,000 growing tax deferred in your retirement account. Does that make sense? You have two options: not put the $1,000 in the retirement account, and in that case, you're going to be left with $670 after paying your taxes. So you've already earned $330 on your $670 that you invest, right? Earn 1,000, pay taxes, have 670, or put the money in a retirement account and have the whole 1,000. You've already earned a 49% on your money. Now, yes, you will owe taxes on that money when you take it out later, which that's just how it works. But the benefit of these retirement plans is you keep the compounded earnings on the government's money. The government basically gives you the $330 that you didn't pay to them, that you could have paid if you didn't put money into the retirement, and you invest the $330 and you keep the compounded earnings on that money as long as the money remains invested. That's the beauty about opening a retirement account, putting away the money. And the earlier you can open it, the better, because the secret ingredient of investing is time. Time is what makes these investments grow exponentially, and time makes it where if you invest money systematically and start early, you will be in a position where you should have enough money saved to retire. Okay, so if you take nothing else from today's talk, think about earning 49.25% on your money and put as much as you can afford, or up to the legal limits, the annual limits, into a retirement account. There's three options out there that most self-employed people use to put away money. They'll put money into SEP IRAs, simple IRAs, and solo 401ks. They're all fine. A SEP IRA for 2024, and you still can put money away. You have until the due date of your tax return, including extensions. So you have till April 15th to set up and fund a SEP. You can put away 20% of your net self-employment income after expenses, up to $69,000 this year. So it's a ton of money. If you have a solo 401k, the cap is $69,000. It's easier to get there than with a SEP because of just how it works. If you're 50 or older, for last year, you can actually put away $76,500 into a SEP. And to do so, you need to make about $200,000 in self-employment income. But you can put away a ton of money. And what I've seen over the years is when people retire, there's only two options. They either didn't save enough, which is bad, or they saved too much, and they'll be in good shape when they retire. Nobody saves the exact amount because nobody knows how long they're going to live. So you want to put yourself in a position where you're one of the people who are going to save enough over their working years, where they're going to have enough to retire comfortably. And lastly, for people who are making good money, don't have a lot of expenses, and haven't saved enough for retirement, there's a more sophisticated plan called a defined benefit plan, where you can put away a lot of money. And a lot of people who do those, they'll do it the last 5 or 6 years of their working career and really ramp up their retirement savings. Okie dokie. So let's see. Let's see if we have any follow-up questions for the retirement while I'm here. 1 second. Okay. Oh, so I'm going to circle back. I told you what someone asked about what's considered the general vicinity of where you live. That's if it's far enough away that you can't go there and come home without resting. Okay, if you're working at a job that offers you a retirement account and you're putting money into this, can you also set up an independent retirement account as well? And the answer is yes. So you can have multiple retirement accounts. There are limits to how much you can put away each year. So if you work for a company and you put away the full $23,000 as salary deferrals into their 401k plan, then you can't set up your own solo 401k plan and put away $23,000 as well. The amount you can put in as salary deferrals is capped each year, no matter how many plans you have. But if you work for a hospital and you're also self-employed and you don't own more than 50% of both. So you own 100% of your self-employed business. You probably own 0% of the hospital. That means that you can set up a plan for each, and you can max out whatever you can to the hospital, and then you can set up your SEP IRA or something like that personally and put away extra money from your job. So a lot of people do that, and it's a great way to defer taxes on some of your self-employment income. And that says, can you move money from a SEP to a solo 401k without penalty? And the answer to that question is yes. So if you have set up a SEP IRA and then you want to set up a solo 401k because you can put away more money on less income. There's some other advantages too. If you set up a solo 401k, you can actually borrow half the balance. I think it's up to, it used to be 50,000. They might have increased that. So if you have a solo 401k and you need to borrow money from yourself, from your own account to either buy a home or you have some type of financial emergency, you can do that. You can never borrow against a SEP IRA. And the other thing, if you're looking to do these things called backdoor Roths, which I'm not going over here, but if you want to do a backdoor Roth, you need to clean out your SEP IRA. And by moving that into a 401k, it achieves that. So there's another question on what's the difference between a SEP IRA and a solo 401k. So the solo 401k is actually it's a real retirement plan. It's a 401k plan. So a SEP IRA is the most basic of retirement plans for someone who is self-employed. So with a SEP IRA, the individual retirement account, the IRA is the funding vehicle. And you can put away, if you're self-employed, 20% of your net self-employment earnings. If you set up an S corporation, and we're going to talk about that, that's not always the greatest idea. But if you set up an S corporation and you pay yourself payroll, you can put away 25% of your W-2 wages into a SEP IRA. They're very easy to set up at the financial institutions. There's no cost to set it up. There's no annual filing. But you can put away 20% of your net self-employment earnings. A solo 401k, if you're under the age of 50 for last year, you can put away 23,000 as salary deferrals plus 20% of your income. So it has a SEP IRA component of the 20% of the net income, but it has a salary deferral component of 23,000. So if you make $100,000 net self-employment earnings, you can put away 23,000 in deferrals, 20,000 for the employer portion. So you can put away 43,000 on $100,000. If you do work somewhere else and put money into the 401k plan, you have to be a little bit careful. And then are there any caveats for defined benefit plans? So defined benefit plans are really sophisticated. They make sense the last 5 or 6 years that you're in practice. So a defined benefit plan, you can put away like $150,000 or $200,000 per year, depending on your income. The problem with the defined benefit plan, there's a few problems. First, you have to accept a lower rate of return because it's you have to the rate of return has to be predictable. So it can't the plan won't work if it invests in volatile options like mutual funds, like stock equity mutual funds. So they're expensive. The rate of return is reduced. When the money comes out, you pay taxes as ordinary income, which is a higher rate than capital gains. Long term, like on the surface, they sound better than they are. They are really good, but it's not the end all be all. You really got to work it through. I think if you're short with your retirement savings, you're gonna be doing some locums work for the last 5 or 6 years of your career. Your kids are grown, your house is paid off, and that's the time to take advantage of a more sophisticated plan like a defined benefit plan and put away money for your kids. But the key thing is you want to put away as much as you can, as early as you can, because you want to get the government's money invested in your account and really benefit from the compounded earnings on those accounts. Okay. So HSAs, these are great. These aren't actually that new anymore. They used to be new. So I think they came out when the young George Bush was president. So HSAs, that stands for Health Savings Account. And it has the best of a lot of different features in there. So to be able to put money into a health savings account, you need to have a qualified health insurance policy in place. So when you get your health insurance, whoever you get the health insurance will let you know whether you have a qualifying high deductible health insurance product in place that allows you to put money into a health savings account. And if you have a qualifying plan, then you can set up your own health savings account individually. You don't need to go through an employer to set it up. And here's how great these health savings accounts is. The money that you put into an HSA is tax deductible. The money that comes out of the HSA comes out tax free. So it's one of the only places that I know of where you get a deduction for the money going in and you don't pay taxes on the money coming out. The money in the HSA grows tax deferred, just like an IRA or any other retirement account. And once you turn 65, if you have so much in your account that you can't use it to pay for your medical expenses, which I'm turning 60 this year, I find hard to believe, then you can take the remaining money out and you owe income taxes, but no penalty on the HSA money. So they're great. Save taxes when it goes in, grows tax deferred, comes out tax free. The amount you can put away for a family plan, it's for 2024, it's $8,300 you can put in, and that's doesn't matter what your deductible is. It's just the maximum is $8,300. For individual plans, it's $4,150. It's increasing to $8,550 and $4,300 next year. And it's a great tax advantaged account, great place to put some money. What I see a lot of people doing, if they can afford it, is they'll fully fund their HSAs every year. And then when they have their family's medical expenses, instead of taking money out of the HSA to pay those bills, they'll just pay the health insurance, they'll just pay the healthcare costs directly out of their checking account, right? So they go to a doctor or they have some healthcare cost. And when it comes time to pay the bill, they have a choice. They can take money out of their beautiful HSA that's nicely invested, growing tax deferred, available to take out later, tax free, or they have money sitting in a checking account doing nothing. And they can take it out of either. There's no rule saying you have to pay your health costs out of the HSA. Unlike if you work for a big company that has a flexible spending account, in FSA, there is a use it or lose it component. But an HSA doesn't have anything like that. So the HSA is, it's great. Put the money in, save taxes. If you don't need to take the money out to reimburse yourself for health costs, don't. And it's another account where money is growing in a tax advantage envelope. Okay, one question. Okay, so one question is, can you have both an HSA and an FSA? And the answer is no. You can only have one during the year. I guess one at a time. So if you're working for a company that has an FSA and then you lose that job or stop working there, and you start somewhere else, at that point you could start the HSA. If you're on Medicare, Medicare is not a qualifying high deductible health insurance plan. So once you're on Medicare, you can no longer put money into an HSA. Can you set up an HSA if you are on your partner's insurance plan? Well, your partner would need to have a qualifying high deductible health insurance plan, and then combined, you can put away the $8,550. Or if you have your own individual account through your partner and you have a qualifying high deductible health insurance plan, then yes, you can put money into an HSA. If there is a domestic partner advantage for HSA with two non-married people are on the same family high deductible health insurance plan, can they each deposit $8,300? No, it's $8,300 per household, per family. But they can each deposit $4,150. Or one can do $6,300 and one can do $2,000. Everybody who's covered can do it, but the combined total is capped at the $8,300. I don't think there's a rule. No, whoever's on the insurance can do it. That's my understanding. All right, great questions. But HSAs, if you have access to them, don't overlook it. Keep in mind that if you can afford it, the purpose of insurance is to protect against the catastrophic financially, the financial catastrophe. So I know health insurance does pay a lot of people's expenses, but as you go through your career, that becomes less and less important. You want to protect yourself against something tragic happening financially and personally. And then you can shift to an HSA and fund that and put money away. So yeah, don't overlook it. And if every insurance plan now is high deductible. Like I know we don't have a qualifying high deductible health insurance, but my out of pocket for my family is really high. So it just I would try to find a plan which allows for an HSA. As you can see, I am a big fan of HSA. Oops. Okay, so now you're working for a is this right? Yeah, you're working as a 1099 contractor, you're no longer working as a W-2 employee. You do need to pay taxes during the year. And the way you do it are these things called estimated taxes, estimated quarterly taxes. It's not that big of a deal. You just have to figure out what you need to pay. So once your income is consistent year in and year out, it's very easy. You base your estimates on the prior year tax. Otherwise, you just project out what you think you're going to earn, and most tax software has some element of a tax projection component, or your if you use an accountant, your accountant can definitely make this calculation for you, and you pay it throughout the year. The reason you want to pay quarterly estimates is because if you don't pay quarterly estimates, there's a chance that you're going to owe an underpayment penalty. There's calculations that the IRS uses. Basically, to avoid being subject to underpayment penalties, the amount of taxes paid in during the year needs to exceed 110% of your last year's tax, or 100% if you make less than 150,000. But 110% of last year's tax, or 90% of the current year's tax. If you don't meet either of those exceptions, those safe harbor exceptions, then expect to owe a little bit extra interest on your taxes. It's not a big deal. The cheapest money you can borrow from the government is to be late with your estimates, but you're better off paying them and getting your taxes paid in that you're going to owe. But if you don't, they will ding you with some interest, and you're going to pay a little bit extra taxes. There's an IRS resource on paying estimated taxes. The IRS at irs.gov, there's a way to pay your taxes online. I strongly recommend, if you are going to pay estimates, either set up an account with the IRS or just use that website to make the payment. Believe it or not, it's not really safe to send checks to the government, to anybody anymore. People are going to the post offices and stealing checks and whitewashing them and all that stuff. So paying estimates, they made it very easy to pay them online. It's safer, it's quicker. I have two clients who mailed in their checks, and both of them, I had two clients who mailed in their fourth quarter estimates, and they both been emailing me that it didn't clear. Finally, one of them couldn't take it any longer, so she paid the same amount again online, and guess what happened the same exact day? You got it. The bank cleared her other check. It took like 3 weeks for the government to clear their check. Just use the irs.gov, make a payment application. It's online, and it's just much easier. I wouldn't do it on a public Wi-Fi, but otherwise I would do it. Okay, QBI deduction came out that one during Trump's first presidency. It's a pretty good deal where people who are self-employed get a deduction of 20% of their self-employment income. There is a phase out, but the phase out's pretty high. If you're married, filing jointly, the phase out is between $384,000 and $484,000. So you get the QBI deduction. It's something that the tax software will calculate automatically. It's supposed to put the tax you pay on your business, self-employed business income, in line with what you would pay, what the corporation would pay, right? Because in 2018, they dropped the corporate tax rate to 20%. So it's something to know about. You can kind of plan a little bit if you're in these phase outs to maybe reduce your income to get a bigger bang for your buck. But it's good. There is a special rule for people in the healthcare field where they are considered, do I have it on here? No, they're considered in this class of people who don't get the full benefit of the QBI if their income's too high. But if your income is below these thresholds, single under the phase outs 191 to 241, and joint I already said, there's a deduction sitting there waiting for you, and it'll help you save some taxes. QBI. This was a bigger deal when we did this talk back in 2017, 2018. When this came out, there was some confusion about how this whole thing would work. Okay, so planning tips here. Let me just see. One sec, sorry, look at the questions here. Okay. Okay, so one person said, back to the HSAs, where do you set up an HSA? If my deductible is only $1,000, is that too low? To find out whether you have a health insurance plan that qualifies for you to contribute into an HSA, the best thing to do is ask the insurance company that you get your insurance from whether that policy qualifies someone for an HSA. It's either HSA eligible or it isn't. Usually they put it in the name of the plan. So, but if your deductible is $1,000, you are not going to be HSA eligible. That's too low, I think. And then this person said, just to clarify, if you have a job that requires a W-2, so you are paying those taxes, and you work locums, you also have to pay quarterly taxes. You need to make sure that the total taxes paid in between your withholding and your estimates exceeds either 110% of your last year's tax or 90% of your current year's tax. So if you work and make 50,000 and then work as a locum to make 100,000, it's highly unlikely that your withholding from your $50,000 job will be sufficient to fully cover, to fully meet either of those exceptions, especially the first year you're doing locum. So you just have to work through the math, but it's just two conditions. 110% of last year's tax has to be covered, or 90% of the current. And as a contractor, there's a question about PLLC or an S-corp. We're going to get to that in a minute. How are we doing? 2:43. Okay, here's some planning tips for you. So the first planning tip is, we call it the 40% rule. So if you're working as a locums, get in the habit of moving 40% of your net income less expenses into a separate account for taxes. If you put aside 40% of what you make, you're going to be in good shape for taxes. Now, don't forget, when you're paid as a 1099 contractor, you owe federal taxes on that income, state taxes on that income if you live in a state that taxes, or live or work in a state that taxes. And then you also owe Social Security and Medicare taxes on that income. When you work for somebody, they withhold Social Security and Medicare taxes at a rate of 7.65%, and then the employer matches what you contribute dollar for dollar. So the government's getting 15.3 cents for every dollar you earn, up to a certain limit, which is like 160,000. If when you're self-employed, when you're a 1099 contractor, on that income, you're going to pay federal taxes, state taxes, and self-employment taxes. So it ends up being like a 40-something% tax. It's very high. If you put away 40% of what you earn, you shouldn't be caught short when you do the taxes the following year. And if you're paying estimated taxes, you pay it out of that bucket of money. So you can earn these days 4.5% interest rate on your savings. Set up a savings account to hold your tax money, earn some interest, and then cover your taxes. Submit quarterly estimates. We talked about that. Track your professional expenses. So by the time you pay your federal taxes, your state taxes, and 15.3% for Social Security and Medicare taxes, every dollar of expense is going to save you 43 cents in taxes. You do yourself a big favor by tracking expenses over the course of the year. You can either use a spreadsheet to do it, use a program like Quicken to keep track of your expenses. Maybe your bank has some way to track your expenses. Use a credit card just for your business-related purchases. Set up some system to keep track of the expenses so you don't lose track of any of them. Keep good records. As I said, it's important. And you're gonna. The first and best way to save taxes is actually, the first and best way is to keep track of your expenses. The second way is to put money into a retirement plan based on what you earn. We talked about the retirement accounts and the HSA as a way to shelter some of the income from taxes, and consult the tax professional. Yeah, this stuff's confusing. We see it all the time, right? Just as whatever you do, whatever your specialty is, it's easy for you, but it's tough for the people who you treat because they only deal with it every once in a while. So there are things that accountants, especially those accountants who work mainly in with healthcare professionals, we just hear what everybody else reads and sees and thinks about, and we just kind of put it all together. All righty. So state taxes. So it's kind of complicated, but it really isn't. At the end of the day, you're going to pay taxes based on whichever tax rate is higher, based on where you work or where you live. So you're going to pay taxes at the higher rate. The way it works is you first pay taxes in every state where you live. Where you work. You first pay taxes on every state where you work. So I live in Massachusetts. If I were to do locums in Rhode Island, I would first pay taxes to Rhode Island on all that income. And then I would do my Mass return, and I would calculate my Massachusetts income tax on that income and take a credit. Take a credit for the taxes I paid to Rhode Island to offset my Massachusetts income. Okay. And because the Rhode Island rate is higher than the Mass rate, my Mass taxes would be fully offset. And essentially I'm paying Rhode Island taxes on that income. So let's say we flip it around and I live in Mass and I do my locums in New Hampshire. Well, New Hampshire doesn't have an income tax. So my tax rate, I wouldn't owe any taxes to New Hampshire, but I would owe Massachusetts taxes at 5% on all that income, which is the Mass tax rate. So you first pay taxes where you work. You take a credit for those taxes paid based on the taxes you pay where you live. And together you pay taxes based on the state where you work or live that has the higher tax rate. Yeah, I wrote it right here. Essentially, you pay taxes based on the state where you live or work that has the highest tax rate. And the last thing I want to talk about is S corporations. So S corporations potentially do save you taxes. There's things you can do with an S corporation to pay taxes, but if you're in a locum situation, it may not be worthwhile. When you set up an S corporation and you're going to work in multiple states under your S corporation, your S corporation has to register in all those states as a non-resident corporation. It's a lot of work. And when you have an S corporation, you're supposed to pay yourself a reasonable salary. And you're supposed to pay the salary and have state taxes withheld based on the state where you're working. So if you have an S corporation, you have to register in all these states. You have to file income tax returns, S-corp income tax returns in all the states. You need to apportion your income, and you need to work with a payroll company that's going to withhold taxes in all the states. It's a nightmare. It's going to be very expensive. There's no way it's going to be right. The compliance, it's going to be a huge headache. It's not the best thing. To take it a step further, S corporations, as I said, they do make a lot of sense. We have a lot of clients who have medical and dental practices in Massachusetts, and they're pretty much all S corporations. S corporations are perfect for that. But for smaller businesses where you're going to make, 100,000, 150,000 during the year, I'm not sure you're going to have the savings in the S corporation by having an S corporation to warrant the costs and the headaches associated with having an S corporation. Because when you have an S corp, all of a sudden you have to do an S-corp tax return. You have to either do it yourself, which is probably tough to do. It is tough to do, or pay an accountant to do an S-corp tax return. You need to put yourself on payroll. So you have to, you start working with a payroll company to handle your payroll. And that costs, even an inexpensive one with one payroll check a month, is $600-700 a year. You're going to be subject to payroll taxes on the income, like unemployment taxes and things of that nature. Not most, but many states have to have a minimum tax in the state. So by the time you pay the payroll taxes, the minimum state corporate tax, the accountant to do the tax return, the payroll company to do the payroll, you're in it for like $4,000 or $5,000 in fees. You have headaches. And if you only make $150,000, you're not really making enough to benefit from some of the benefits that you get from an S corporation. So if I were doing locums, I wouldn't rush to incorporate. If you set up a thing called a PLLC or an LLC in your state, an LLC with one owner that hasn't elected to be treated as an S corporation, it's just a disregarded entity for tax purposes. So you can set up that. It doesn't do anything for your taxes, but the S corporation can turn into quite a headache, and financially it's just a drag on the whole situation. So as you can tell, for locums earning 150, 200,000, I'm not sure it's worth it. You also lose out on the QBI deduction, the way the formula works, because your W-2 salary that takes away profit that's subject to the QBI deduction. So the advantages of forming an S-corp is you do save Medicare taxes and maybe Social Security taxes if your income is low enough. There's a way that you can avoid the $10,000 limitation on state and local income taxes that was implemented back in 2018 with the SALT tax, but the pitfalls are big, and I'm not sure the pitfalls outweigh the benefits, or the benefits outweigh the pitfalls. So, yeah, we've had people who are locums who come here after they set up the corporation, and it's just not worth the effort for people making less than $200,000. Okay, so questions. Let's see what we got here. We have 5 minutes or so. Went through that stuff pretty quick, but that's all right. Okay, where are we here? As a contractor, is it better to be a PLLC or S-corp as far as tax benefits? There are some, as I mentioned, S-corp does provide a few tax benefits, but the costs and headaches of being an S-corp, I don't think the benefits outweigh the costs. Does it matter how much I pay myself with my LLC to decrease my taxable income? If you have an LLC that hasn't elected to be treated as an S corporation, you're a sole proprietor. And when you do your tax return, if you're a sole proprietor, you do this form called the Schedule C. that you attach to your federal income tax return. So you do a Schedule C, you pick up your income, you write down all your expenses, and you're taxed on the net income. You're taxed on the net income whether you leave all the money in your LLC bank account or you take out the money. So does it matter how much I pay myself from an LLC? The answer is no. That's irrelevant because you're not really paying yourself. You're just drawing out the profits. If you file it jointly, do you base it on your spouse tax contributions also? Yeah, if you file jointly, the total combined taxes paid in through both of your withholdings and estimates need to exceed 110% of last year's tax or 90% of the current year's tax to avoid being penalized. Can you talk about a business loss if you only do a few hours of locums per month and taking that against your income? Okay, so your W-2 income. So if you work as a W-2 employee and you also work as a locums, but you didn't work that much and you had expenses that exceed the income, your Schedule C that's attached to your personal tax return will show a loss. And yes, that loss can offset the wages when you're calculating your taxes. So if you, let's say you combine wages of 200,000, you have a loss on your Schedule C, you have of $10,000, you'd only be taxed on $190,000. The Schedule C loss goes right against your W-2 income. I do want to point out that in all my years, we do 2,000 tax returns a year. We've seen very, very few audits, especially recently. The people they audit are people who have Schedule C losses. So if your expenses do exceed your income, I wouldn't be so anxious to take a loss in your Schedule C. Maybe you incurred expenses at the end of the year and you're going to have more income next year. Well, in that case, you can take a loss this year. And if you get audited, you can just show the government that the following year you did have income. But be careful with taking a loss on your locums because you wouldn't do it for a loss. You do locums to make money. But that's a good question. Do you know if there are going to be changes in taxes relative to telemedicine? That's really complicated because I think some states require people to allocate some of their income to that state based on where the patient is located. I don't know how they're going to enforce that. And I don't know that much about that because we don't have any clients who are doing that. But that is going to be an issue. Just how they changed the rules where now Amazon and all these other people other big companies have to withhold taxes from a state, even if they don't have any location in the state. They are talking, or they have already talked about states requiring telemedicine people to allocate income to their state. I don't know. I don't know exactly how it works, and I don't know how they're going to enforce it. What if you have a government pension and you do locum? Yeah. So if you have a government pension and do locum, good. The government pension is taxable as pension income. The locum is taxable. The amount you earn as a locum won't offset your government income, your pension. You get your pension no matter what. So you just save more money. You should be in a position to put away a ton of money this year. Save a lot. You don't need a second home. You don't need a boat. You don't need a 65-inch TV, even though those are pretty cheap now. What you need is some nice low-cost mutual funds and watch that money grow, and also max out the retirement on your locums. So in that situation, if you have a government pension and you're doing locum and you can afford it, you might want to set up a solo 401k. And if you don't need the locum income to live off of, but you do want to build up a little bit more of a nest egg for retirement, the solo 401k is the perfect thing. And in your situation, you basically, it's not direct, but the government pension is going to fund your 401k, solo 401k. You're just using your retirement or distributions to fund your retirement account. If I save 10% of 1099 income for retirement, 30% of 1099 income for savings, would I still owe 40%? Well, it's 40% isn't perfect anyways. 40% means you should be in good shape when it comes time to do your taxes. Yeah. So if you can do 40% of your income less retirement savings if you want. I don't know. It's not an exact science. Taxes isn't an exact science. What do we have time for? A couple more. I was retired for 2024, but received residual income on a 1099 MISC, then locum income on a 1099 NEC. Can I report these incomes on my Schedule C? The 1099 NEC you can report on your Schedule C. The 1099 MISC, it matters what box they put it in. If they put in box 3, that's actually other income And that's not Schedule C income. That's not subject to self-employment taxes. That's just other income. So it matters which box on the 1099 MISC they put the income, but on the 1099 income, you can definitely you can report, you should report on the Schedule C. What is the last date to contribute to a SEP IRA? Fidelity mentioned that I could contribute up to 69,000 up until the end of 2025. Okay, so the SEP IRA, the due date to establish and set up a SEP IRA for one tax year is the due date the following tax year. So if you don't go on extension, you have until April 15th to set up and fund your SEP IRA. If you do go on extension, you have until October 15th to fund the SEP IRA. So they do give you a lot of time. Yeah. What a lot of people do is if they can't afford to pay all their taxes and fund the SEP, they'll put in an extension, they'll pay all the taxes due on April 15th, and then they'll fund the SEP over the summer. Great questions. If you have established an HSA account and you change jobs where a high deductible insurance plan is not available, then do you have to close out the HSA? No. So if you have an HSA account, that account can be kept open forever, for as long as you live. And then whoever inherits your money inherits it. So there's no use it or lose it component. And there's nothing where when you no longer have an HSA eligible account, do you need to close the HSA? Once an HSA account is set up, it's your account to invest the money as you see fit and to take out money to pay your family's healthcare expenses as you see fit. So there's no urgency to close it out at that point in time. It's just a nice tax advantage account where you can keep some extra money. Is there value to setting up an LLC? I don't know. But potentially for legal purposes, and a lawyer can help you with that. But an LLC that doesn't elect to be treated as an S corporation is a disregarded entity for tax purposes. The government, they're nothing. It's disregarded. It's as if you're a sole proprietor. Oh boy. I worked 2 years, last question. I worked 2 years locums out of state. In one state, they added travel reimbursement to my income for the year and gave me a set Fed tax lower than my tax rate. And that was added as income as well, a set Fed tax. Now I am 3 months break from job and going back. Now I go back to not having reimbursement. Okay, if you're in a situation and you get reimbursed for your expenses, you can't deduct those expenses on your Schedule C, except if those reimbursed expenses are included as income on your 1099. So if the place where you're working includes on the 1099 the money they paid you and the reimbursements, you want to report that total amount as income on your Schedule C and then write off the reimbursements as travel expenses. And that will make it so you only tax on the income you actually earned. And if you work for 2 places, last question. So if you work for 2 places and they do it differently, the one that puts the reimbursements on the 1099, you want to write off those reimbursed expenses, and the other one you wouldn't write off the reimbursed expenses. So your goal is to pay taxes on the right amount of income after claiming everything that you can. Great.
Government prefers that, yes.
Yeah, pay your taxes. Yeah.
Yes. Thank you so much, Andrew. This has been so helpful. I know that there may have been questions that were not answered, but I do get a transcript of everything. So I'll try to go through them and I'll circle up with Andrew after and see if he can answer some of the bigger questions. And then I will email those out to everyone on the call. So if you have any further questions, you can feel free to email info@bartonassociates.com and I'll receive them and then I can sift through them. But everyone will get a copy of this following the end of the webinar. Give us a few days to edit, the beginning out and get our documents together, but don't worry, it will be to you before tax season.